Hello, this is Compound Interest Stock Guy, and today in this video I want to talk about how I believe we should value cannabis stocks, so stay tuned. If you're new to the channel, please subscribe, hit the bell down below so you're notified when I upload a video, leave me a comment, share the video with friends, I appreciate it. I also want to disclose I'm not a financial advisor. This is just for entertainment information purposes. Do not buy or sell based on anything I talk about in this video. So what I want to talk about is I don't think a lot of people that are invested in the cannabis stocks really understand fundamental values. A lot of the people I know have made a lot of money just by following hype and following what all their friends have bought, and that same mentality is not necessarily gonna help them out in the future. You know, if you bought CannTrust based on hype, there was a lot of hype on CannTrust. Yeah, I mean, lots of stocks, right? They've gone down a lot based on different things. But what I'm saying is, though, in the future, what's gonna separate the companies from going bankrupt and the companies that are gonna really, you know, they're gonna shape their piece of the pie is gonna be about profit margins. It's gonna be about net income. It's going to be about their cash flow, and I have been emphasizing those kind of things in the last few videos. I'm sure I've kind of touched on them if you've watched my last like 15 or 20 videos. Again, it's hard to talk get so into depth on that in a 10 to 15 minute video. I'm just driving around on my iPhone, so I don't have the time to make a 30 or 40 minute video and go super in depth, but I am going to touch on this stuff. So basically, net income is what a company makes. So say they make 15 million in profit margins when they sold their product. Okay, that's good. Now their SG&A is all their administration and all this other general and other kind of expenses that get added. So if they have a lot of those that are higher than those profit margins, then the companies will take a loss. So they will take a net loss. Okay, they can take a net loss for other reasons. It could be due to like convertible debentures and other stuff as well, but just based on the business, those are the things that I really try to focus on. Again, that's really important to me. If a company has a really tight balance sheet, okay, for example, today I'm just gonna talk about Even Co Cannabis. Okay, they only sold about $450,000 of cannabis, but their expenses were so little, they were like really low, that their biological inventory was able to give them a profit, right? So it would be the same as if a gold miner, you know, they didn't sell all the gold, but they produced that much gold, so that should be counted as revenue. So even though it's not booked, it will have a perceived value in the future. So again, it's not as solid and concrete as gold or silver, but again, gold and silver prices also fluctuate as well, so there's things to that. But anyways, what I'm saying is, though, that company had a really tight SG&A, so when they start doing $5 or $10 or $15 million, they're gonna kill it as far as their net income goes, right? So a company such as Even Co, if they stay on the straight and narrow, they're gonna make the investors. I am an investor. I hold 4,000 shares. I used to have 5,000. I don't have as much anymore, but I have 4,000, and I'm gonna hold till it's a lot higher. When they start going a lot higher, then they'll be able to eventually, in a few years, when they're running at and they start doing like 20, 30, 40, 50 million, they could potentially do dividends for their investors. So that's getting hot, right? I like that about the company. So, but companies such as True Leaf's already doing those kind of numbers. They're doing $20 million in net income for the quarter. Now Village Farms is doing about 9 million. So, but on top of True Leaf, they're also doing biological inventory added as well. So they have EPS of 52 cents. Okay, so on Wall Street, the way the institutions and analysts, how they value stocks is based on like a PE ratio, and it also is based on cash flow, and then they also base it on competition riding into their profits in the future and killing their market share. Those are the things they account. They're also in different industries, if it's a growing industry and all that stuff. So there's all these things that get added to the equation. So as far as it goes right now, when I find companies such as like Grow Generation, okay, that's like a perfect example, right? If they're gonna keep the way they're running, and they're gonna have the same quarter over quarter, you're gonna make a lot of money on that company into the future. Because, okay, so they do $19 million in net income, not net income, but in revenues, and then they do 1.2 million in net income. Okay, so they say they do 1.2 million in net income, that's 5 million, okay? So on a PE ratio of 30, that's 150 million market cap, okay? So that's what they're at. That's like, in the market, the big companies generally have a PE ratio of anywhere from like 10 to 25. So that's kind of the basis of things. So then, I mean, generally like 18 to 25 to 30, and it can be a lot higher as well. In a big growing industry, PE ratios can be like in the hundreds or 200s, right? Like I've seen it afford like Amazon, like a 200 PE ratio, and some other companies like Netflix or something. I mean, I can't be sure about Amazon with their PE ratio, but I know I've seen 200 PE ratios in very big companies. So that's kind of the basis of things. So Grow Generation, they're running at that rate, and then their price of sales is around 2, based on them doing the same kind of revenue next quarter. So that's very low. Like the big companies in the alcohol industry, they run at about a 4 price of sales, but they also have a lot more cash than what Grow Generation has. So they have some type of moat around them, right? That's what Canopy and Chronos has. They have a moat around them, okay? So then that keeps them from getting killed and annihilated when there's a market downturn. So there's things of that nature. Now with Grow Generation, on their quarter by quarter, so say they do like 40% quarter, like year over year and stuff, so next year then they're doing like 28-30 million, and then they're doing like 3 or 4 million in net income, then they're doing like say around like 12 to 15 million. So based on their market cap, if they were to stay at the same PE ratio, then they should be around like 450 million. So if they don't dilute more, then their price should appreciate 2 to 3 times from where it is, okay? Now on speculative companies, you're just basing on the fact that the share price is going to go up, and you think it's going to get to there. And that's what the whole traders who are putting money into that are basing their whole opinions and their outlook and their investment money based on it reaching that level. But there's no reality to it. I mean, maybe the company never gets there, maybe they go bankrupt, maybe in 5 years it'll happen, right? So there's no fundamental like reality on what's going on. So that's what I'm changing my values as far as an investor. I want to be an investor more than a speculator. Okay, in this industry in the beginning, I had to be a speculator. I had to be. In order to participate in the cannabis industry in the last few years, you had to be a speculator. And you still, there's goes without saying, I think there's, whether you're investing into Apple or you're investing into Amazon, you still have to speculate on their future being good, right? But it's not as big of the money. Like, it's not their market cap based on speculation, it's based on fundamental. So, but a lot of these cannabis companies, their market caps baked into the fact that it's gonna reach that level, and it may not, right? So that's called speculation money. that's what I'm gonna call it. So now companies like Village Farms, when they're doing 9 million of net income at a quarter, and that's like 40 million, right, a year, then it's like, okay, that's like an 8, like a, if you do a 20 PE, then that's baked into that they should be valued at 800 million, okay? But the street's gonna look at, oh, well, they got, say, 200% year over year. If they continually do that, what is their net income going to be next year to keep that PE ratio, right? So, and then they can give them bonuses on top of that for their market cap. So that is the basis of how these institutions in Wall Street base their investment money on, because they can't do the speculation trade and look at, like, I don't know, Halo Labs or Suniva, and like throw like $5 million into the company and say, oh yeah, well, in 5 years it's gonna make 500 million and it's gonna make 120 million in net income, so I can invest $5 million. They don't do it like that. These guys have lots of money. They can't be just speculating on their investments. They have to be like down to earth and look at it like, okay, this is what's gonna happen. Now, that's what they and it's also not federally legal, so they're not want to do it there. But now with like Aurora Cannabis and like MetaPharm Labs, or then they look at, okay, their quarter by quarter, what is their market share in the cannabis industry and things of that nature. So it's different, right? But you always have to look at companies' cash position and their ability to raise cash. So like Aurora's being able to raise cash with the bank and all that, but some of these companies that don't have a good track record, they have a tougher time to raise cash. So that's the thing. I mean, we're in a very risky like industry, but the growth is like really effing high. So, but I do want to lower my risk in the future when I get out of a lot of my positions and just solely focus on the companies that are creating like profits, and they're like the grow generations, the true leaves that I believe Afria will start to be profitable. Village Farms, and yeah, just have the best, and also just keep a lot of cash on the side for good times. But I also just want to play it like cyclical, like just sell in before the end of the year and then buy at the end of the summer, kind of. So I just want to stay in liquid, but I do want to eventually have like a portfolio where I just have the best, and then I was like creating like a dividend cannabis portfolio. Like maybe in 2 or 3 years, there's like 2 or 3 stocks that are giving a dividend. Like IIPR is giving a dividend, but that's too expensive for my blood. So, but maybe like Village Farms will, maybe when they're making like $500-600 million a year in cannabis sales, and they're doing like 100 million in net income, that they don't need to like use that to expand their business. They're gonna just give it back to their investors. So anyways, I hope you learned a lot about cannabis investing and not speculation investing that a lot of us cannabis investors have been doing in the past. We're coming into a new cycle. So anyways, thanks for watching. Give me thumbs up, and keep compounding your info, listen to my lingo, and until next time, peace.